Ever wondered where fortunes are made and lost in mere seconds? Welcome to the world of the stock market. This thrilling universe is where everyday people can become millionaires, or where millionaires can lose it all in the blink of an eye. But what is this stock market, really? Well, it's a public marketplace for buying and selling shares of publicly traded companies. These shares represent a slice of ownership in a company, and as the company's fortunes rise and fall, so too does the value of its shares. It's a high-stakes game of strategy and risk, where the rewards can be astronomical, but the pitfalls deep and perilous. And yet, it's more than just a game. The stock market is a mirror reflecting the ebb and flow of our economy. It's a barometer of economic health, and its fluctuations can impact nations and economies worldwide. Now, are you excited to dive into the world of stocks and shares? Hold your horses. We need to understand the basics first. The stock market isn't a mysterious beast, it's built on some simple concepts. Let's think of it as a giant supermarket where you can buy and sell pieces of companies, and these pieces are what we call stocks. So what does it mean to own a stock? Well, when you buy a stock, you're buying a small piece of a company. You become a part owner, or a shareholder in that company. You get a slice of the pie, so to speak. And this slice gives you the right to share in the company's profits. That's why investing in stocks can be profitable. But how do you make money from owning stocks? There are two main ways. First, if the company does well, the price of the stock may go up over time. This is called capital appreciation. If you sell your stocks for more than you bought them for, you make a profit. Second, some companies share a portion of their profits with their shareholders in the form of dividends. So, if you own stocks in these companies, you may receive a regular income even without selling your stocks. Now you might be wondering, how is the price of a stock determined? Well, it's all about supply and demand. If more people want to buy a stock than sell it, the price will go up. If more people want to sell a stock than buy it, the price will go down. But what influences this supply and demand? A lot of factors, really. The company's financial health, economic conditions, even news about the company or its industry can affect people's perception of a stock's value. But here's the thing. The stock market isn't just about making quick money. It's about investing in businesses you believe in and sharing in their growth over time. It's about understanding the risk and reward, the ups and downs, and having the patience and discipline to stay the course. Understanding these basics is the first step to becoming a successful investor. So, in the next scene, we'll take a closer look at how to start investing. Stay tuned. Now that we know what stocks are, how do we go about investing? Well, the first step is to open a brokerage account. This is like your bank account, but specifically for buying and selling stocks. There are many online brokerages to choose from, each with their own unique features. Some cater to beginners with user-friendly interfaces and educational resources, while others cater to more experienced traders with advanced charting tools and analytics. The key is to do your research and find the one that best suits your needs. Once you have a brokerage account, the next step is to choose what stocks to invest in. This is where research and knowledge of the market come into play. You'll want to look at a company's financial health, its growth prospects, and its position within its industry. You'll also want to consider external factors such as economic trends and geopolitical events. There's no surefire formula for picking winners, but a well-informed decision is always better than a shot in the dark. But here's a crucial piece of advice. Don't put all your eggs in one basket. This is what we call diversification. It's the practice of spreading your investments across a variety of stocks from different sectors. The idea is that if one stock performs poorly, it's offset by others that are doing well. Diversification isn't just about reducing risk, it's also about maximizing potential returns. If you only invest in one sector, you'll miss out on opportunities in others. And finally, you need to have a long-term perspective. The stock market is volatile, and it's normal for stocks to go up and down. But over the long term, historically, stocks have proven to be a good investment. So don't panic when your stocks take a dip. And most importantly, don't expect to become a millionaire overnight. Remember, investing is not about getting rich quick, it's about steady growth over time. Compound interest, the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. This is a quote often attributed to Albert Einstein. And while we can't verify if he actually said it, the sentiment holds true nonetheless. So, what exactly is compound interest? At its simplest, compound interest is the interest on interest. It's the process where the interest you earn from your investment also earns interest. This might not sound like a big deal, but over time, the impact can be quite significant. Imagine you invest $1,000 into a stock on your 25th birthday. Let's say this stock gives you a return of 10% per year. After 1 year, you've earned $100. Now, here's where the magic happens. In the second year, you're not just earning interest on your initial $1,000, you're also earning interest on the $100 you made in the first year. So, your investment grows a little bit faster. Now, let's fast forward to your 50th birthday. If you just let your investment sit and grow, you haven't added any more money, but thanks to compound interest, your initial investment of $1,000 is now worth over $11,000. That's a pretty nice gift to give yourself, isn't it? But the power of compound interest isn't just about waiting, it also rewards those who start early. If you start investing at 25 instead of 35, you could end up with almost double the amount of money by the time you reach 50, and that's with the same initial investment and the same annual return. So, while the concept of compound interest may seem complicated, its effects are simple and profound. It can turn a modest investment into a significant sum over time, and it rewards those who start investing early. That's the magic of compound interest. It's the key to growing your wealth in the stock market. The stock market doesn't exist in a vacuum. It's a mirror of our global economy. As we delve deeper into the labyrinth of finance, we begin to see the intricate connections between the stock market and the world economy. These two entities, though distinct, are inextricably linked, each influencing the other in a perpetual dance of cause and effect. Firstly, let's discuss investor confidence, a crucial element that drives the stock market. This confidence is a reflection of how investors perceive the health of the economy. When investors are optimistic, they buy stocks, pushing prices higher. This buying frenzy can stimulate economic growth as companies raise capital to expand their operations. Conversely, when investors are pessimistic, they sell stocks, leading to a drop in stock prices and potentially slowing economic growth. Now, let's talk about capital formation. The stock market serves as a platform where companies can raise funds for expansion by selling shares to the public. This process, known as an initial public offering or IPO, allows companies to grow, create jobs, and contribute to economic prosperity. Without the stock market, this process would be significantly more challenging. Lastly, the stock market functions as a barometer for the economy, providing valuable economic indicators. Stock indices like the Dow Jones Industrial Average or the S&P 500 are often used as proxies for the overall health of the economy. When these indices rise, it typically indicates a growing economy, but when they fall, it can signal economic downturns. In essence, the stock market isn't just a playground for investors, it's a complex system that reflects our economic reality. It's a mechanism that facilitates growth, a platform for capital formation, and a barometer that gauges economic health. So, the stock market isn't just about individual wealth, it's a barometer of global economic health. So, are you ready to dive into the stock market now? We've journeyed together through the thrills and spills of the stock market, the ABCs of investing, and how to take those first crucial steps. We've explored the magic of compound interest, and how it can grow your wealth over time. We've also delved into the profound impact the stock market has on the world economy. Let's not forget that investing is more than just making money. It's about financial independence, securing your future, and perhaps even making a difference in the world. It's about understanding the economic heartbeat of our global society and participating in its growth. So what are you waiting for? The stock market, with all its complexities and opportunities, is waiting for you. It's a journey, not a destination. It's a process, not an event. Remember, the journey of 1,000 miles begins with a single step. Start your investing journey today and see where it leads you.